following presentation is for educational purposes only. All the symbols, trading ideas, and market commentary are for educational and demonstrational purposes only and are not recommendations or trading advice. Live sample trading occurs in a simulated environment. Past performance may not be indicative of future results. All the information and content presented is provided by NinjaTrader LLC, and the opinions expressed by all third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.
Hey, Tom. Long time no see. Long time no see. How are you?
Hey, Jim, I'm doing well. This is a great event that we can do on a Thursday afternoon, kind of unusual.
Yeah, it's really I'm really a little worried, and I'll tell you why. Because this meeting has been kind of under everyone's radar screen for at least the last, I'm going to say, 4 weeks because of Tuesday. And there could be some surprises. I think the 25 basis point cut is going to be, that's baked in the cake, as they would say.
Yeah.
But there's going to be a dot plot. There's going to be future projections, possibly some forward guidance, and all of that stuff. So there's going to be a lot of moving parts this meeting.
Yeah, I agree, and you're right. I think baked in the cake refers to the fact that there's a pretty big probability we know what's going to happen. I wouldn't rule out anything else, but that probability is about as high as you can get. So take that with a grain of salt. I think it'll be interesting. It'll be more interesting to hear what Powell has to say, but I think we get an insight into what he's going to say with the statement that comes out at 2 p.m. as well.
Yeah, no, for sure. So what we're going to do today, folks, we're going to spend the next hour together. Me and Tom are going to be your hosts for the first half hour. And we're going to look for trade ideas today, and we're going to talk about the FOMC results. And then at 2:15, halfway into our hour together, Dan Gramza from Gramza Capital Management is going to join us and offer his unique and very high-level analysis of what's going on here. And again, we'll be looking for trade ideas all along the way. So appreciate everybody being here. We'll have a short 1 minute or 2 minute break in between. But so it's a special event, live trading around the FOMC. Tom, I think we are ready, man.
Yeah, and I just want to say it's going to be great to have Dan on. Dan brings not just a wealth of experience. The technical side, of course, is what I'm, intrigued with. I like to hear what he has to say about the charts themselves, but I think combine that with the experience he's had, how many years in the market and going through this, however many times he's gone through it. I think it'll be a good combination of fundamental and technical with Dan.
He might even be a little older than me, so he's probably not much. He's probably seen a few more cycles than I have, so which is always good. So let's start off by taking a look at what the Fed Watch tool. This is the CME Group Fed Watch tool, what it's telling us right now. And I just refreshed it right now, and this is showing the column on the left is the meeting dates, right? So these are all the meeting dates projected all the way out to December 2025. And then we have the probabilities of where the Fed funds target range is going to be, at least from a percentage point of view, across this matrix, I'll call it, Tom. And it looks like right now, remember, Fed funds right now is between 4.75 and 5.0. So this furthest right column here is suggesting, hey, we have a 99.1% chance of a 25 basis point rate cut.
Yeah, that's about as good as it gets without being 100%. It's pretty close. And, Bobby said he hasn't seen deviation. When he's seen something above 95%, it pretty much comes in as expected. What's really interesting to me, Jim, is, kind of towards the mid of 2025, the market is well, again, the probabilities wane, but the market is pricing in another 75 basis points cuts after today, if we could get 25 basis points today, and it kind of stays there, right? So, but I think we have to remember that these are traders like you and me, right? These are traders that are projecting this. This isn't the Fed saying this is what we're going to do. This is these are the traders anticipating what the rate will be based on whatever analysis they have, right? And so this could be accurate, this could be a little bit off, but you'll notice those variations in percentages really get, pretty wild, pretty, you look at end of the year, there's a 0.1% probability we'll have another, what is it? 1.25% cut. So, that's just one person maybe saying, hey, Hail Mary, things are going to go this way. And then you've got, other people saying, you know what, after today's cut, we're not going to have any, and that's a very small percentage again. That umbrella or that fan widens the longer the time gets out there. But these are market participants making this matrix, not the Fed.
Yeah, and if you look at the top here, this is Fed funds futures, right? So you can see the November contract, the December contract, January, February, March, April, May, you could all the way across, right? So it's a monthly contract all the way across. It's traded, right? And there's the last traded price, at the underneath each cell there. And so whatever the algorithm is, they take this data and they pump it in down here and give us this probability sheet. So the further out you go, and the farther out you go from a contract month point of view, the more the more volatile it is, the bigger the spread. And that's why you see these kind of crazy numbers here at the bottom of 12/10/2025. But it'll kind of, this will recycle as we go, right? So the top 2 or 3 maybe are the most important, I think.
Yeah, Jim, if you think of those prices, if you subtract them from 100, that's about the rate that you're looking for, give or take. And these are futures, right? So you have different months and they don't line up with the meetings. Some, the meetings are every 6 to 7 months. These futures, you're looking at one every month. So there's a calculation there to adjust for the futures. And then of course the range, the high and low ranges. We're seeing a snapshot of what the price is now, but the percentages are based on how much volume was traded at the high or the low. It's not a simple calculation, I guess. And that's why we get these probabilities, but it really is about those 12 contracts right there, projected into the end of next year.
That's right. Great point. Great point. And if you go over to, and then we have a dot plot this time, right? We have a summary of economic projections. It's every other meeting. That'll be today. We'll pull it up when they release it at 2 o'clock. But they also track it here to a small extent, right? They look at the Fed funds rate, and each dot represents, I think there's 19 of them. They each represent an FOMC participant. And so you got to kind of get a median forecast from the folks, the stakeholders at the table, and how they see future changes in Fed fund rates.
Right, and those blue dots are kind of the I don't know, Jim, I'm going to lose it.
The median or the
is it the median? I don't think it's the median. It's the price where there's the most
the mode.
The mode. Is it the mode? Yeah.
I don't know. I know there's 3. I know there's median, mode, and something else. There's another M.
It's the one where the most, it's like the point of control, but for dot plots. Let's go.
Oh, there you go. Well, I don't know. This one over here has 2, and there's 3 dot plots below.
Oh, you're right. You're right. Maybe it is the median or the mode, one of the 2.
I don't know. Whatever. Anyway, we're going to see how this changes. We'll see. What does it even tell us here? Median. There we go. At the bottom. Oh. Geez, look at that. We got to just scroll down. Blue dots indicate the median projection. So we'll see how this changes, right? Because we're going to get a brand new one.
Yeah. Yeah.
By the way, fly it here says purple tie ?
Yeah. So that's referring to, I think Engineer Bear was saying earlier, and even in this text or chat, what color tie is Powell going to wear?
Yeah,
he's been wearing purple. Will he continue? So interesting. I kind of see them as politically agnostic when it comes to signaling. So he still might come out with that purple tie.
Yeah, and it could be good luck. It could be his lucky tie. You know, it's funny because when we were in the floor back in the day, there was a guy, he wouldn't be out there every day, but he'd be sitting in front of the door and he would have, you know, he had these little American flags.
Yep.
And you know, he was trying to sell his little American flags for, you know, for money in the mornings when all the traders were walking through. And it got to a point where it was bad luck not to buy one. And, you know, it's like $1 or something like that, right?
Right.
But it was bad luck not to buy one. It's like, did you get your flag today? Yeah, I got my flag. So there's superstition everywhere here, man.
Wow, that's pretty interesting.
Yeah, yeah, it was fun. It was funny. You know, even the traders that bust out that day, they still had one. So I'm sure they weren't happy, but
Funny, funny.
yeah. So anyway, so Tom, we have, I don't know, what do we have here? We got 4 more minutes left, and then we'll pull up some info. We'll keep an eye on the market. I have the E-mini S&P up here, the micro E-mini S&P up here. I'm going to be looking for some trade ideas in this market. If you think we should look at another one, I'm all ears.
No, I think this is great. You know, Jim and I, after the midday stream, we were discussing, you know, we were in a meeting with Mike and, you know, just kind of looking at 6,000
Yeah.
as a possibility of a target. And just for fun, we put that on simulated account and got filled. We did hit
Yeah.
6,000. So if you had E-mini beating gold and Bitcoin to their respective targets, winner, winner, chicken dinner. But
Yeah.
since then, you know, to me, that's the kind of trade where you hit 6,000 and you back off right away. If this isn't you know, this has been trending quite a bit today. You know, kind of follow through on yesterday. We've just been in this bull mode. I won't say overextended because we could certainly get up there again, but it's one of those things where that target's so close, somebody's going to try and get 6,000, even though maybe the market really shouldn't be there.
Yeah. For sure. Now, I've also loaded up a strategy, an OCO strategy here.
Love to see
It's
it.
called FOMC E-mini S&P, and we'll just take a peek at it really quickly here. How do I open it up? Hang on a second. What is that? I'm trying. I'll hit the edit button. That should work. Okay. So a 2-unit trade, 2-contract trade. I have, for my first target, I have a stop loss at 10 and a profit target at 10 and no trail. For the second target, for the second unit, I have the same stop loss 10, a profit target 32. These are ticks. And then custom for the stop strategy. The stop strategy is going to basically, let me show you. We're going to do a one step. So once we hit a profit trigger of 10, in other words, that first order gets filled, then the stop loss for the second one will shoot up 9 ticks below the profit trigger. That's how this works. So 9 ticks below the profit trigger, and then frequency of the trade will be tick for tick. And it'll make more sense if we get in the trade and we could show it, we could demonstrate it. Whew. Anyway.
So you did a 1-unit trade, right?
So it's a 2-contract trade on my strategy.
Okay. So the target 1 and target 2 are your first 2 targets.
Yeah. Target 1 is 10 ticks from my entry. Right. Target 2 is 32 ticks from my entry. I was thinking 8 points.
Okay.
And then once target 1 is achieved, then a trail will start for target 2.
Got it.
I'm just anticipating some velocity in this, in the idea that, hey, we got to go. You know, we got to go fast.
Mm-hmm.
So we'll see how it works. I was thinking about doing it in the micro Nasdaq, but sometimes that market goes bananas.
Yeah.
And that's a CMT term, Tom, I think.
It's chapter 7.
Yeah. And I also added after the opening range of an anchored volume profile. So we'll see how that plays out as well. Really nice point of control right below that 6,000 level. Like Tom said, we ticked up to that 6,000 level, and I got out, Tom, at 59999.75, and I had an order to sell up at 06, thinking we were going to overshoot, and then we'd come back down. We didn't overshoot though.
Yeah, high of the day today, 6,002. That's an all-time high on the E-mini futures. So, you know, that overshoot didn't happen the way you thought it would. It only overshot 2 handles. tried to get back down to the opening range, and it didn't do that. Sometimes you'll see the importance of the opening range, and here we go. We just had the announcement, and it acts as support. So, do we even have to look at the news to see what happened?
Well, it's exactly what we thought, right? Say rate decision, 25 basis point cut is just happened, right? So previous, and it's a range, really, guys. It's a range. It's between two numbers, but I'll give you the high end of the range. It went from 5% down to 4.75%, which is exactly what we were looking for.
So once we have that, what do we call that? This kind of an announcement is embargoed. What that means is at 2:00 exactly is when the data is released, but also with that comes the statement, right? And that statement isn't it released to reporters like a half hour before, but they're in a room that they can't broadcast any information till 2:00. So they have time to write up their analysis and release it to their news wires or to their editors before it hits the news wires at 2:00. So they're not waiting, 15 minutes after the announcement. People don't care about that. It's moving on to the next thing. But the statement, I think, is what people are dissecting right now.
Yeah, and the only thing difference in the statement that I just saw was this sentence right here. Inflation has made progress toward the committee's 2% objective, but remains somewhat elevated. So that's kind of something to think about. I mean, the devil is in the details here. So we're going to get more data out in about a half an hour, but that's what just hit the street right there.
Look at that. I mean, you just did almost the entire range of the trading since 10 o'clock in one candle. We didn't quite get to the high. We didn't get quite to the low of that, but that's a pretty wide, long-legged doji right there.
That is a long-legged doji. I love that.
Yep.
I love that. Who makes this stuff up, Tom?
Somebody much wiser than me, for sure.
Probably somebody on the CMT testing committee.
No, I think this is candlesticks, so this could go back 400 years, right? I don't think they were on well, at least I didn't know. They weren't on the testing committee back then, as far as I know.
Yeah. I'm going with purple tie, Tom.
All right. That's a safe bet. I think that's good.
Yeah. So now we wait till 2:30. Now Dan's going to join us in a little while here, and which is great. So right now, like I'm waiting for a trade idea, and there's two. We have how long do we have? We have 27 minutes left, right? Before they wheel Chair Powell out, and he reads his speech, right? It's a speech, and then Q&A start when usually this thing goes haywire. So, do we do value area trading right now, right? Try to get long if we wick down to the bottom of the value area. Try to get short if we wick to the top, or of the profile while we're waiting, or we keep our hands in our pocket.
Yeah, I think it's more about value area trading might be a little bit wide for this, just because you're using that area. I apologize. I'm looking at the whole day. From the opening range, after the opening range till now. So forget about the opening range in pre-market. I just want to see what happened after that. And that's how I have this profile drawn. Now, my fib line tells me what happened all day, right? Before that, rather. So that gives me some measurements that I could consider also. Yeah, this is a tricky one. I think that's not a bad thing. It's that level for the opening range low. What is that? 59.67 is that? 87 rather?
87, yeah, in 3/4, yeah.
Yeah, so that's right about where the opening range high is, realizing that the first candle after the opening range did dip back down in the into the opening range area. So I think that's not a bad idea if we can get back down there, but we might even be a little bit tighter than that as we wait, because think about this. This candle that was formed is again almost that range, total range to the opening range low, and I just don't think it has the drive. I think it's still anticipatory till 2:30. Maybe it is. Maybe it is turn around and find support at that 87 level. Or maybe we try to get back up to near the high of the day at 6,000. But maybe it's in the journey, right? Maybe it's something we surround and see. But this still is it just isn't making up its mind.
Yeah, I have some more data here, Tom, too. Inflation has made, I already read that sentence. Vote in favor of this policy was unanimous, so no dissenters. Everyone was cool with it. We will continue reducing bond holdings at the previously announced pace. So quantitative tightening is going to continue with no policy modifications there. This is starting to sound like a nothing burger, by the way. Economic activity has continued to expand at a solid pace. Labor market conditions have generally eased. Unemployment rate has moved up but remains low. And they omitted the reference that they had in last month, Tom. They omitted the reference that we have gained greater confidence in inflation moving substantially toward the 2% target. So there's a little bit of flavor here that's suggesting, well, we kind of stopped or slowed our progression toward that 2%. And you combine that with inflation remains somewhat elevated. So this is the first signs that we're hearing about, okay, maybe the rate cycle is going to slow down a little bit more than we thought.
Yeah, I think thinking about this after September's 50 basis point rate cut, if there have been critics saying, why are you cutting? Right? Why are you cutting? You don't need to cut right now. The economy isn't in free fall. Especially 50 basis points. We had all those economists that were polled right before the September meeting saying 25 basis points is enough. I think by going 50 in September, it kind of takes away from that idea of why are you cutting and puts the focus on, well, why did you cut 50, right? So it's almost like, of course we're going to cut. Now, why is that an issue? Because there are people saying maybe inflation isn't under control yet, and the fact that they took that out of their statement, that they don't have that. What was it? We have greater confidence, or
we have. They took out. We have gained greater confidence. Inflation moving substantially lower.
Okay, so they took that out for a reason. All these, and Stephen Jonathan is in the back of my brain saying this. I've heard him say this so many times. Everything in that statement is there for a reason, even omissions, right?
Yep.
So if they said that one time, they said that last meeting and now they don't say it, it's true. It's because they don't have greater confidence in getting to their inflation goal of 2%. So, maybe this is worrisome, and it makes sense they didn't go 50 basis points again. But, that's what they look at. Yeah.
So I just sold a contract, right? It's at 96.75. I'm sorry, Tom, I couldn't help myself. This was the top of the value area. So I thought, okay, so let's try to do it. I know we're kind of sideways bound, waiting for the presser to happen because nothing surprising happened other than that omission. And there's my stop. Here's my first target, right? And the idea here is this is automated, by the way. This is ATM. If my target is filled, then I'll only be short one contract, and then this stop loss is going to automatically jump down to here for the remaining contract, if in fact this market cooperates. So we'll find out. Otherwise, I just get stopped out, and everything else is canceled automatically. It's an order cancels order. Sorry to interrupt, Tom. I just saw it happen, and I just wanted to mention it.
No, that's great. I mean, that's the beauty of the automated orders, right? The order cancels other is. It's kind of like no fuss, no muss, right?
Yeah, my hands are free. I'm gonna drink my cocktail. I mean, my water out of my NinjaTrader cup. Yeah,
you're gonna drink your tab. What about let's take a look at the Nasdaq, because we talked about which market you might want to go long in. If you're bullish, you want to go in the one that's performed the best or is the strongest.
Okay.
I'm
going to pull up another chart, though, since I have an OCO on here. I'll probably muck up the works if I toggle.
Yes, right.
Because I have everything linked to my market analyzer. So, but we could do that, Tom. We could do that easy peasy. I'm just going to pull up another chart here. We'll keep that dome up. I'm going to type in MNQ. Hang on, I might have actually. No, these are all daily charts. Daily charts. I'm looking for a quick and easy way to do this, but I will catch up. Don't worry.
So what I see,
yeah,
with NASDAQ while you're waiting, it just hasn't been able to progress like the E-mini did, right? So I think somebody talked about 21,200 today, and we did just reach that level here on the last 10-minute bar, but it just doesn't look the same. It just doesn't look like it's a little more anticipatory than the E-mini.
All right, so my first target was hit, Tom, real quick on the E-mini S&P, and you'll see the stop is trailing tick for tick.
Yep.
As we go down. Now, eventually, of course, either I hit my faraway target. This was 32 ticks down, or it will, the stop will catch up and we'll get stopped out.
Awesome.
So again, all automatic. I'll just pull that to the side and I'll let you know how that goes. So Nazi, sorry about this time. I'm up and running.
No worries.
Now. There we have it.
So you can see, it's just been kind of hitting the ceiling right around 21,200, which, nice number. Yeah. I think we'll probably see a little volatility after 2:30. Question is, where does it end up? We've seen so many roller coasters during the press conference. This is just like a spring waiting to uncoil.
Yeah, no, I hear you. And I just drew a rectangle, of course. So this is how it helps me visualize support and resistance. Got a lot of resistance up here, approximately. Okay, so we got, by the way, E-mini S&P, that second unit got stopped out for a tick winner. Remember, real-time simulated live account, past performance not indicative of future results. And my target was automatically canceled. So that OCO worked out pretty good.
Excellent. And R. Crawford did ask, is the stop going to trail? Yes, it was. Is a pretty tight range, right? So,
yeah, we'll put on another one, Scott, as soon as the real action happens here at 7:30. As soon as the real action happens at 7:15 when Dan's here.
Right.
That's when the real action starts. Oh boy.
By the way, Jim, I know we do this in the live stream during the morning. We should do it here. Patricia Meyer, first in the chat. Shout out goes to Patricia. Then maybe we can do some acknowledgments. John Boynton is here. Engineer Bear. Cliffy Nader. Cliffy, I haven't seen your name in here for a while. Welcome back. Anissa, good evening to you. I said Engineer Bear. We have Fly It here, and Paulie is here. R. Crawford, Scott K, and Dan Grigonis is here. Now, Dan, I think that NASDAQ high might be the index, but I could be wrong. That might be the futures high in July. Did we? I thought we took that out in the futures, though.
I think we did. Well, let's find out. Yeah. So I am not back adjusted, Tom. So we did not.
We did not take it out yet. Right.
Oh, wait a second. What am I looking at? Yeah, this is Nat Gas still.
That's Nat Gas.
Hang on a sec.
I thought
we're talking about the NASDAQ, right?
Yeah, go to your tab below. You've got the NASDAQ down there.
Yeah, but that's a 10-minute. Here's a daily.
Okay.
Yeah, we did. Look at that.
Yeah. Okay.
Yeah. Often, and not only a little bit, not by a little bit, but by like a massive amount.
Right. Right.
I mean, not massive, but this is a pretty big candle. This is not a small candle.
Right.
So we'll keep an eye on that. This is sticky at the top right here. We'll see. My guess is it won't be so sticky in about, I don't know, 16 minutes.
Yeah.
So Tom, I think we're ready though. I think we're ready to introduce our good friend from Chicago, Illinois. I think Dan Gramza is with us right now.
Right. So let's take a quick break, Jim, and we'll bring Dan back on.
All right, let's do that. Tom, Dan Gramza is in the house.
Is he next to me? I think he's next to me.
He's right next to you, man. How you doing, Dan?
Hey, all right. All right. Great to be with you guys.
Yeah,
well, thanks for being. Go ahead, Tom.
Good to see you, Dan.
Thanks, Tom.
He's always like the best dressed guy in the room.
I know.
Oh, it's no big deal. I just throw a tie on. Everybody does their thing, and I'm comfy, just my typical thing.
Yeah. So, Dan, FOMC today, second to last meeting of the calendar year. We had a 99.1% chance of a 25 basis point cut, according to the CME Group's Fed Watch tool, for several days in a row now. And sure enough, that's what happened. Is this, are we just kind of drifting into normalcy now, or no?
No, I think it is. Well, yes, in a way, it's the expectation. This Fed cut has been baked into the market for a while. And what's encouraging is they didn't do 50. The 50 basis point, I felt, last go around wasn't really needed. But anyways, all right, so they did a quarter. I think that's right on target, what they should do. Now, do they give us hints about the future? And, we have two CPIs coming out. We've got another data point to add in there, another labor point to add in there before the December meeting, which is like December 17th and 18th. So will they have another excuse to do that? And I think they may. And then if we look at next year, the magic number for the Fed, we always talk about the 2% inflation. And the other magic number for them is the 3.5%, right? So that's their target rate that they're looking for, and they could reach that in 2025 with a few more cuts. But I think one of the things that happens here is when people hear this, the expectation is, well, my so-and-so price is still higher, whatever that may be. And that's not surprising. As you guys know, when the Fed cuts the interest rates like today, it's 3 months to 6 months, and actually some people feel 18 months before our economy feels it. Market responds instantly, but it takes a while to absorb it through our entire system. So prices don't change instantly. And you also have that, I kind of think of it as a friction or this viscosity of pricing when you think about a company, whatever it is, restaurant or whatever, that has increased prices and their profitability's up and inflation may be down. Do they really want to adjust those prices back to, low inflation? There's some, lag in that regard too. So I think it's all part of the picture. When people hear Fed changing interest rates, then what do they feel personally? It takes a while.
So go ahead, Tom. Sorry.
Well, so a couple things there. I think, you're spot on. With inflation, when inflation goes down, it doesn't mean prices go down, right? People have to disconnect that idea. It's just the rate at which prices go up goes down. So, we had a big inflation a couple years ago. Prices aren't going down from there. They're just going up slightly. They're going up at a slower rate, let's say. So, people say, "Oh, inflation's down," and people might not know that doesn't mean prices come down. The other thing is if prices go up so much as, let's say, a small business owner, I start losing business, I'm really reluctant to take those prices back down if inflation comes down. Because again, it's not about prices coming down to me, the consumer, or the restaurant purveyor, let's say. It's just that now I got to make up all that lost business too.
Boy, that's right on target, Tom. Excellent point. You're absolutely right. There is friction in here when we think about pricing and our economy, and we think about it on a personal level. Each one of those have their own rate of change. And you're right on target. It's if I've gone through a tough time, if I've really lost business, and or my employment cost has gone up as I'm trying to keep my employees. It's a delicate balance there of when and how or if you change pricing.
Yeah.
Yeah. So Fly It here, one of our great in our community, Fly It here's here a lot. We appreciate him. He said, like when they cut Social Security, they do not lower it; they just raise it less than planned.
Well, no, it's a good point. The rate of change of an increase, and then what is the appropriate rate of change? What is the right benchmark that they should have for Social Security?
Yeah.
You know, and what number, what indicator really reflects what people feel in their pocket.
Yeah.
So I think that that person's got a good observation
Yep.
about the impact of change.
So I have my own economic indicator. It's called Mrs. Cagg's credit card, and it never gets smaller. Ever. It just keeps creeping up.
I'll tell you what, pal, don't count on that one changing. You know?
Oh my God.
I think that'll stay the same.
So Dan, when I was out west, I was in the West Coast last week. My wife took my 12-year-old out to dinner. One of our favorite restaurants in the area, not a chain restaurant, a local restaurant. And she told me when I came back, she said, I don't think we can go there anymore. It was over $70 for two people not drinking alcohol, right? 12-year-old and the mom. $70 for dinner. And it was like a burger place. I mean, it wasn't tablecloth service.
Right.
It's a pub. So, I just think at some point, people are going to say this is enough. Hopefully, the Fed cuts rates and things, prices won't come down, but they won't go up as fast. Let our wages catch up.
I think you're right. It's a tricky balance.
Yeah.
But so Dan, you mentioned a 3.5 Goldilocks number for the Fed and the 2% inflation for the Fed. What if the neutral rate's not 2%? What if the neutral rate, because it's kind of an arbitrary number, right? What if it's 2.67 or something? Should Fed funds be that close to it?
Ooh, that's a great question. I don't know. Because when you think, no, it is a great question. I don't know the answer to that because if you think about those numbers, they're they are somewhat arbitrary. You think about the 2%. It's not just the United States that uses the 2% for inflation. Look, any developed country, that's the mark they're using. I mean, look at our friends in Canada or Japan or, Australia, Europe. They're using that 2%. And some people can justify, well, if you subtract this from that, you can get 2%. It's an arbitrary number, the way I look at it, that's being used globally. Then let's take your point. What is the cost to get to 2%? Right? That becomes the real challenge. So going back to your point, do we need to have the Fed funds rate at that level to really have an impact? Or does lowering that cost dampen our economy to a point of now we don't have recovery? We're losing momentum. More and more people are going to be laid off at that point. And then we have a very serious economic situation. So I don't know the answer, but I would want to find out actually, because I think the cost to our economy to find that out could be very high.
Yeah. And I'd imagine it's just the math should be different for an emerging market country and a developed country.
Yes. Yes. I mean, that's what's so fascinating about interest rates and about currency rates, which they go hand in hand. And what's interesting about interest rates, it is not only the cost of money, but it's the cost of risk. When we look at other countries, some people say, well, look at that country. You get a 24% return on a savings account. Well, there's a reason it's 24%. You can put money in, but can you get money out? And are there tax consequences to touching that country? We see it in the carry trade where people try to capture that interest rate change. And so interest rates really are an interesting barometer of a country's economy. So what rate is the magic rate that gives us, what do we want? We want low unemployment and we want low inflation. That's the Fed's job. And that's why the political side of this it creates a certain expectation, but the politics in this area we're talking about really aren't highly correlated.
Got it.
I don't think anyways,
Yeah. So, all right. So let me ask you guys this question. So we had two major events this week, right? We had a presidential election. We have an FOMC. We had huge rallies in the equities. How much? So are both of those events baked in the cake already? In other words, we hit 6,000 in the E-mini S&P, just I don't know, maybe for fun. I don't know. We hit it. We broke back. We're right below it right now. Is anything Chair Powell could say right next? And he's pretty careful in what he says. Could move this thing either all the way back down or just shoot it through the roof.
I don't think so at all. He's going to stay to the script. He doesn't have any marker to dramatically change what's going on. If you look at all of our numbers for the economy, for the labor market, we're steady as she goes. And, the Fed is very slow to make any changes in terms of policy and the words they use to describe that. And they're always going to have the caveat depending on the economic reports that we see. So that I think is going to stay the same. The political event that you mentioned, excuse me, I find really interesting because I think at first it's 50-50 how the market's going to react. But it usually, if you go back, I can't remember how many elections I've now followed this on, but if you look at the day of the election, we typically have a positive start. I mean, it's a good thing. It's our system at work. So it's almost like the economy says, hey, look, we have a presidential election. It's working. The second thing then is how does the market absorb the information as it comes out? I got to tell you guys, I was really surprised that we got the number results that we did so quickly. When in 2020, it was Saturday before we really had all the answers. And here we got it in one day. And maybe it's because states have gotten more efficient. Go ahead.
I think partially too, back then there was COVID going on. So there was this extra level of, don't come near me, right? With 6 feet apart, that, wear your mask, all that nonsense.
Yeah.
And so that slowed things down quite a bit. I think they probably didn't have as many poll workers because some people just didn't want to risk it, right? And, there was that layer of I won't say inefficiency because you might argue that it was necessary, but it was something that we had never dealt with before. So protocols and everything were completely new for a lot of poll workers, the ones that showed up. So yes, it was surprising because we kept talking, Jim and I and Mike, we won't see the results of this election till Thursday at earliest. They were prepping us for that. But, it was kind of refreshing to go back to where the results were known within 24 hours. That's just kind of a good thing, I think.
Yeah, I think you're right. Thank you, Tom, for bringing that up. That's a very important point because you're right. That really did slow the whole process down. And I guess when I look at it, I think about it as a barometer. Yesterday was a barometer. It was what I call an anticipation move. So what is the market saying? It's anticipating that this result, see, it chokes me up thinking about it. This this result, the anticipation is it's going to have a positive thing for this market. Now, is is Trump president? No, he's not. That's not going to happen until January 5th or 6th or whatever. So it's not going to happen for a while. So does he have a direct impact on our economy now? No.
No.
But it's baking it in. It's the anticipation that something could be positive down the road. And here's the tricky bit. When you see a market moving on anticipation, typically there's a couple of things one thing you don't want to see is you don't want to see the market going vertical. That what we saw yesterday continues to happen every day. It's not really a good sign for sustainability.
Mm-hmm.
But what we do know is the expectation that's been created. And so what you look for is for it to maintain that. And, my thoughts for today was not to look for a screamer, excuse me, not to look for a big day. And because yesterday the market said, hey, that presidential election, it's worth this much to the S&P. That's what it's worth, right? That's what you and I saw. It's worth that many points. Today, the Fed, another biggie, but again, it's nothing shocking. So I think the market is behaving somewhat orderly. What fascinated it did fascinate me is how we saw stock market up big time yesterday, right? And we saw the dollar stronger across the board on all these currencies, which impacted commodity prices, which are priced in dollars. So ergo, it's going to have an impact. We're going to see gold and silver and copper, all these markets, crude oil to an extent. Crude oil is a little different, but they responded to that stronger dollar, as they should, because they're priced in dollars, right? So if dollars going up, we expect commodity prices to go down.
Yeah, well, the dollar gave some back today, right? It's a little bit weaker today, and things are turning around. But your earlier point that the administration doesn't change until some point in January. We already, at least as far as Putin is concerned, we have an impact already. He said we are ready to restore relations with the U.S. That just came through the financial juice.
The writing, it's the writing is on the wall for Putin, right?
It is. And what's fascinating in this regard is that perception, anticipation. We saw anticipation yesterday of maybe things get better. And we're now seeing perception that, this guy's getting back in. So I got to rethink things. So now we're seeing that, I guess, the absorption of the news. I didn't see that about Putin. That's interesting.
It just came in now in my news feed when you were talking. Tom, by the way, did you see Engineer Bear?
Yes, purple tie, very good. Good call. Love it. So Fed Powell started speaking 2:30 press conference. First thing he said that was notable was that he continues to be confident that with the recalibration of stance, inflation moves sustainably down to 2%. So he's still, beating that 2% drum, which we wouldn't, like you said, Dan. He's going to stick to the script. He's sticking to the script. The one thing that's interesting, though, it says the labor market is not a source of inflation pressures. Yet we keep having these revisions that kind of indicate maybe a little more job weakness, and the continued jobless claims are at a 3-year high. And back when it was trending down, now it's trending up. That's a kind of a funny way to say labor market isn't doing so great. You want it, a good labor market would be inflationary. And what he's saying here is, well, we don't see it's, contributing to inflation. It's another way of saying, hey, maybe it's a little weaker than we thought. That's my interpretation.
I totally agree with you. I don't agree with the idea that labor doesn't have an impact on inflation. But at this point in time, I suppose we could say we're not seeing the impact of a little bit softer labor market. So maybe that's what he's implying. Because as we all know, if labor's up and it's tight and it's very low in sense of unemployment, then that puts pressure on wages. It puts pressure on people saying, I can change a job anytime I want.
Right.
Right? I can eat because it's so tight. People need people. And we saw some phases of that. And we know the end result is people say inflation's going up. It's that cycle. I need more money because inflation's higher. I get more money. That push inflation up as wages go up. Another factor that we have to consider. So maybe he's just implying that today.
You're right.
He doesn't say that, but I think you're right, Tom.
It's a snapshot, right? Here we are today. They're data dependent. These two things can sit side by side on the same bench.
Yeah, and isn't it interesting that so much of the data we look at is backwards looking, right?
Yeah.
So last month this happened. Well, last month, but what about now? Right? So, but we have that as a barometer, as a benchmark, a reference. But it is backward thinking, and the stock market is forward thinking. What's going to happen next month? Are things getting better or getting worse?
Yeah, but the Fed they're trying to publish more contemporary data. They have the GDP now that the Atlanta Fed publishes, and they have the New York Fed staff inflation now report that they publish. And my guess is they have internal models that are probably better than we know about.
Yeah, I think they do. I know a fellow that was an economist here in Chicago at the Chicago Fed. And the way they try to keep their finger on what's going on, I mean, it is their job. And it's a tough job, not an easy thing to do. But Jim, that's a good point. Maybe that is an indicator of us getting fresher information that the market can use to look at what's going on. And maybe with the evolution of technology, maybe even our time frame may change on some of these indicators, that maybe we'll see them almost real time, which could really change the absorption of the market, on that kind of information.
Well, it begs the question, does AI help us get there?
It may. I don't know enough about it to really say whether the impact's coming in, but the little pieces I see truly amaze me. And right now, I just feel like if you have enough computing power, almost anything's relevant now when it comes to economic data and the freshness of it. But then you got to collect the data if you can speed that up as well.
Well, and Dan, you're right about, I think it's the technology that AI brings, all the, faster processing power. And, I'm not even a techie, so I'm not going to pretend to know what I don't know. But the other thing is, that real-time data is something that we explored when I was at Bloomberg, was instead of looking backward, let's see foot traffic in a store, right? Coming through the doors at a store, retail store, and multiply that amongst all the stores in that chain. And then on that, in that retail industry, shoe stores, clothing stores, whatever, that can be done. That can be done with cell phone technology. And it's just a matter of building that mechanism to do it. It's just, where do you start, I think, to some extent as well. People are doing it. It's just not mainline yet.
So Milo threw in a comment here in the chat, and it just kind of mirrors something that Powell just said. So I'll read Milo's first, and then Chair Powell's. Milo says, "I'm thinking a more reaction in the bond market," and then Chair Powell says, Where'd it go? It's right here. It says it appears that moves in the bond rates are not mostly about higher inflation expectations. Bond rates reflecting growth expectations. Which is he worded it awkwardly, I think. I think what he's saying is I think what Powell's saying is bond rates are not about inflation expectations. They're about future economic growth expectations.
So the
What do you guys think of
higher
that?
rates is what you're saying is we would think that's inflationary because bond rates should come down with rate cuts. They haven't. And where we might think that it's because the market's anticipating higher inflation. No, it's about growth.
Well, could be. I mean, it is the cost of capital. And if we think about the balancing act between dividend returns and that we have in the stock market compared to what we see in the capital markets like interest rates, there is that, where do I put my money? Risk on, risk off. And risk on, I'm willing to give up my steady interest rate on the bond market for more risk on the stock market, which is kind of what we're seeing now, really. And growth, well, I think the sector that would have the biggest impact on that idea would be the Russell. The small to mid cap stocks, right? They're more sensitive to interest rate changes than the large cap stocks because those large cap stocks have a lot of resources to go for capital. So I guess it would be interesting, excuse me, interesting thought and not unreasonable. Is it what we see now?
Yeah. By the way, Malik is short. E-mini S&P targeting 59.72. Everybody.
Very good. Yeah, he was short earlier when it was not going his way. I think beginning of the live stream here.
Yeah.
But now it's we've got a little bit of a pullback in the market. You're tracking the VWAP now, right?
Yeah. If Kevin, if you could pull up the chart real quick. This is a 10-minute candle chart that we have here. And so what I did, Dan, I added a volume profile, which is anchored, and I started it after the first half hour opening range ended, and I dragged it all the way forward right now. So, and it was a really beautiful profile. It's it's Gaussian bell-shaped distribution, point of control right in the middle, and every single candle ever since, I don't know, 1 o'clock is traded through that price.
It's interesting, and that's a beautiful chart you have in front of us, by the way. I've been looking at that, and what's interesting about it is we're seeing very orderly behavior, right? What you just capitalized here in terms of your comments, we're seeing levels of acceptance and levels of rejection. We're seeing levels of acceptance, right? Where you said the point of control, the high volume. And what have we done? We've rotated both sides of it. You look at the wicks on top and the wicks on the bottom, the shadows. We're very balanced right now. And the news of the day has been let out. So far, the Fed hasn't created some kind of unusual volatility, which also I think kind of implies that it was somewhat baked into the market. And yesterday we sprinted. That move yesterday was a sprint. And today, there's a high probability we're going to stop and catch our breath. And I think that's kind of what we're seeing so far. And then what's going to be really interesting is what do we see Friday? Are people willing to go home long this market on Friday? Or are going to say, oh, I got this I got to get out of some of this before the weekend. So do we see profit taking before the weekend? Or do we see it getting high enough that new sellers say, whoa, this is so overvalued, mine at this level, and they sell into it? So I think Friday could be another interesting barometer to this week in terms of how we finish, the attitudes maybe we're going to see.
Yeah, so I agree with that. I'm looking at this volume profile right now. In to a large extent, it's a measure of Chair Powell's performance right now. Right? He can't be too excited or too depressed. He's got to be middle of the road. And so we have this kind of tight profile right now. And this is, I'm kind of being tongue in cheek a little bit here, but this is, assessing his performance at the press conference right now.
Actually, it's what you want if you're the Fed.
Yeah.
I've mentioned him before, but this fellow I know at the Bundesbank, part of his job was not, along with other people, to write the president's speech, but to measure the market reaction globally to the comments from the president. So when the president would speak, he would try to look at globally what's happening in other markets.
Yeah.
Are they responding? Do they respond? What word caused them to respond? I always thought it was an impossible job. But I mean, because what happens if the Bundesbank says something, the Fed says something, and the Bank of Japan says something? What caused the volatility?
Right.
To your point, and it just happened just now, and I'm going to tell you why. But I know this time together just goes by so fast. We're almost done. But because Tom's got another show to do, so he's a busy man. But so Powell just said the change in the statement, right? They issued a statement, and they omitted one sentence. Everybody picked up on it. Powell said the change in the statement, omitting confidence, was not meant to convey anything about the stickiness of inflation. Yeah. So he literally, someone asked him, "Hey, you removed this statement, you removed the confidence statement out of the statement from last meeting to this meeting. Is that telling us something?" And now he's saying, "No, that word change didn't tell us anything."
Who are you going to trust, me or your lion eyes? That's what that reminds me of.
That's good, Tom. But it is what you guys said before. It's that sensitivity of the market to every word the Fed says and how they say it. As you said, Powell's demeanor is looked at when he talks. It's everything's scrutinized.
Yeah, absolutely.
And it's interesting what the market's doing. We saw it break, and now it's trying to firm up a bit. So did it get low enough? It got into those shadows where we found buyers before, and it's still a little bouncy. So are we going to see it slow down a bit? Or we're going to see a commitment to direction before the end of the day? I would think a positive close. Currencies, a little bit softer, so they would be firmer today, would be the expectation. Yeah. But it's interesting. Jim, I wonder if the markets, what we're seeing is what you just said, what Powell's comments were, and the market's now responding to it. It kind of makes you wonder a little bit.
He's still talking. Just wait. We can get back to that point of control in a second.
We're not done.
Yeah, that's true.
So anyway, Dan, our time together always goes so fast. Man, I appreciate you being here with us this afternoon.
Oh, it's always fun, guys. Great to be with you. Thank you for all those great insights. It's such a pleasure to go through these markets. And you guys, this chart is an example of the power of the tools that you have at your hands. So it's really impressive. But thank you for, sharing those ideas with me today, and great to be with you.
All right. Looking forward to talking to you again soon. Coming up right around the corner, Tom, I know you got to get to work here, so we'll wrap up. Tom Schneider's going to be live at bars closing at 3:15 East Coast time. You don't want to miss it. Markets are still moving. So Tom, I'll be there with you as well behind the scenes.
Yeah, I got to go put on my work shirt. But thanks to Dan for joining us. It was a pleasure to talk with Dan always. We wish we could, we'll meet in person one day. You're not too far from where I grew up, so it's just a matter of time. But yeah, this was fun, Jim. Thanks for putting this together, and we'll see everybody in a short 15 or so minutes.
All right, folks, we'll be right back.
The following presentation is for educational purposes only. All the symbols, trading ideas, and market commentary are for educational and demonstrational purposes only and are not recommendations or trading advice. Live sample trading occurs in a simulated environment. Past performance may not be indicative of future results. All the information and content presented is provided by NinjaTrader LLC, and the opinions expressed by all third-party guests are their own and are not necessarily those of NinjaTrader LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.